Good morning. I'm Melissa Harris-Perry. Today marks a very significant anniversary in modern U.S. history. I want to take you back to what we were all watching 5 years ago today and remind you how none of us knew just how deep our economic problems went.
On the broadcast tonight, meltdown. The American financial system is rocked to its foundation as top Wall Street institutions topple under a mountain of debt. Coming up tonight, how did it happen? What's next? And how safe is your money?
At the table, William Cohen is the contributing editor at Vanity Fair and author of House of Cards, House of Cards would be like a diet book. House of Cards, a tale of hubris and wretched excess on Wall Street. I'm really thrilled to invite and have at my table here Soledad O'Brien, CEO of Starfish Media Group, Josh Barro, politics editor at The Business Insider, and Avik Roy, senior fellow at the Manhattan Institute and former policy advisor to Mitt Romney. Thank you all for being here.
Pleasure.
So, Bill, I want to start with you. Right now, are the banks still in the too big to fail category?
Absolutely. They are as concentrated, more concentrated than ever. We've lost 3 of our big 5 banks in this crisis. Bear Stearns is gone. Lehman Brothers is, of course, gone, liquidated. And Merrill Lynch is not nearly what it once was as part of Bank of America. So where we had 5 powerful, top, big Wall Street firms, now we've got 2 to 3, and they're much more concentrated, they're much more powerful. This was a huge lost opportunity. Remember 5 years ago, there was incredible fear in this country. That's when things get done on Wall Street, where the lines of fear and greed cross. This time, we missed this opportunity. The banks are stronger than ever. We haven't changed people's behavior on Wall Street.
Okay, so Avik, on the one hand, I get this, right? I get that what Josh is saying, and this is the too big to fail narrative that emerged, that the banks simply had such an important part of our economy that allowing them to fail would have had even more cascading effects for Main Street. That said, as hard as it may be to understand something like a leverage or a derivative, here's what's not hard to understand. Executive compensation, right? So what the big guys make. And when I look at the economy 5 years later and I look at executive compensation, in 2007, before the crash, it was $8.4 million on average. In 2008, as we're crashing, starts to come down to 7.6. But today, on average, executive pay total compensation is $9.7 million. So if I'm at home watching, I think, well, I don't understand everything, but I understand that somehow 5 years ago they failed, and they're now making much more at the same time that my income is stagnant.
Yeah, and I think that's actually part of what's been going on with monetary policy. So if you look at Ben Bernanke keeping interest rates really low, who has that benefited? That's benefited people who own stocks, that's benefited property owners, and that's benefited the big banks, because they can borrow money at really cheap rates and make a lot of money investing those assets in other ways. And that's one of the reasons why these big banks, not only are they too big to fail, they have a huge competitive advantage in the market, because everybody knows that they have this implicit subsidy, the government's going to bail them out. And so you do need to break up the big banks, because even if you make them smaller, at least there's more competition, and that's the problem right now.
So I don't know if Josh just fundamentally disagrees with you, but there was this face that you made about low interest rates and monetary policy. Yeah.
Yes. No, I mean, who's benefited from loose monetary policy is people who are in work now, we've had even higher unemployment. And the other thing is we would have had deflation if we hadn't had such aggressive action on the part of the Fed.
It's not clear.
It's
counterfactual.
It is a counterfactual, but this is, people keep saying, oh, the Fed is printing all this money, there's going to be all this inflation. Inflation is running around 1.5%. If the Fed had been less aggressive than that, we would have had homeowners even deeper underwater. One of the things that we've needed in the last few years has been easier money policies that would have had actually a temporarily higher inflation.
I think executive compensation, right, is if the bank is doing better and the leader is perceived to be running the bank well and they've made money, they get compensated.
I think people have made this a lot more complicated than it needs to be, frankly. They have their own argot, their own language at the banking level, but it's really pretty darn simple. Okay. It's about incentives. And you had a chance to change the incentives on Wall Street 5 years ago because they badly needed to be changed, because what you have now is people are rewarded to take risks with other people's money.
Yeah. So I know these are difficult times, and I know folks are worried. But I also know this. We can steer ourselves out of this crisis, because we are the United States of America. But it's going to take a new direction. It will take new leadership in Washington. It will take a real change in the policies and politics of the last 8 years, and that's why I'm running for President of the United States of America.
That was then Senator Barack Obama in 2008, less than a month after the economic meltdown. So much attention is being paid to the anniversary that a White House official announced yesterday President Obama will make remarks tomorrow in the White House's Rose Garden to mark the 5th anniversary of the financial crisis and tout the economic progress that's been made. And what kind of progress can President Obama point to? Well, he can mention the unemployment numbers, which were at 6.1% before the crash, 10% at the height of the crash, and now sit at 7.3%. There's also gross domestic product, which is higher than pre-crash numbers, and median household income is not back to the pre-crash amount of $55,000, but is climbing back from a low of $50,700 in August of 2011. All of this leads one to ask, how much credit does President Obama deserve for where we are 5 years after 2008 economic crash? How much credit or blame does the president deserve?
I completely agree with that speech he gave in October of 2008. Unfortunately, he didn't implement any of the things that he promised us. The change we can believe in never happened. He surrounded himself immediately as his close economic advisors with the people who were in part responsible for what happened, whether it was Tim Geithner or Larry Summers, who were going to reestablish the status quo as quickly as possible. What was needed was a fundamental change in the architecture of Wall Street. There was a moment when it could have happened. It didn't happen, and I knew the moment it wasn't going to happen when he appointed Tim Geithner and Larry Summers as his key economic advisors.
I think the president was cautious. He was too concerned because it wasn't maybe a policy area he was particularly familiar with, and so he relied on these people who had the experience, who had been around. But just to Bill's point, those are the people who were in large part responsible for the crisis or were complacent about its causes. And so the Dodd-Frank was a missed opportunity. When Dodd-Frank was going through Congress, a lot of the things that actually caused the financial crisis weren't addressed. And that's the big problem, is we have all this legislation now that supposedly addresses all these things, and it really doesn't.
So I want you to pause there for my viewers and remind folks what Dodd-Frank is and why nearly half of the rules that were meant to have been written have not yet been written.
So Dodd-Frank was the financial and banking regulation reform that was passed by Congress in 2010. And the idea was that it would address some of these issues. For example, banks being too big to fail, it would address that. It would create all these rules so banks wouldn't take so much risks, roll the dice, gamble with too much money. That's the famous Volcker rule, for example. But that rule hasn't been written. Why? Because it sounds simple in concept to tell banks don't take risks with their own money. But the thing is, it's complicated in reality because banks have a lot of assets. What do they do with those assets? Instructing them what to do is very complicated.
What we don't want to do is say, well, we don't need banks, because obviously we do, right? Banks. So how do we shift the profit motivations, the greed motivations, so that they serve a collective good?
But this is the problem, is that the housing policy and the policies that we instructed banks to engage in terms of mortgage lending contributed to the crisis. And that's one of the reasons why a lot of the bankers haven't gone to jail, because they were actually complying with federal
regulations. It wasn't illegal. Yes.
Yeah.
Right.
They were complying with federal regulations that required them to lend to people with below median incomes. And the problem is, when you require people to lend to below median incomes, if some of those people have poor credit, you increase the riskiness of the mortgage portfolio. And this is
that return to the idea that what crashed it wasn't the bankers and their choices, but these sort of irresponsible homeowners.
But this is why I think it's actually a mistake to turn this into a morality play and try to figure out, who's morally culpable for the crash. Because I think it does make sense to say the bankers are much more morally culpable than individuals who took out mortgages that were too big for them and bought homes they couldn't afford.
Because they were told by banks that these, and people, particularly in communities of color, were given subprime mortgages even when they qualified for normal rate mortgages.
And so I think with that framework, the administration and politicians in general have been very reluctant to impose new rules that put more stringent borrowing requirements on homeowners. The qualified mortgage rules that are coming out that tell banks these are the kinds of mortgages you can make without being afraid that we're going to come back to you and say you were behaving inappropriately. They contain no leverage requirement, and the government is still insuring mortgages where people put down as little as 3.5% of the home price because we don't want to blame the homeowners. And I think we shouldn't blame the homeowners, but we should have policies going forward that discourage both banks and individuals from taking unreasonable risks.
Thank you for being here. I hope you'll come back in 2 weeks. We're going to do health care, and we want you at the table when we have a conversation about that. That's right. So just hold the date. Avik Roy, thanks.